Happy Friday. Thank you for spending the afternoon with us. My name is Maya Nitzberg. I'm Greentown's Community Director. For those of you who are joining us outside of Greentown, we want to extend you a welcome. And if you would like to learn more about Greentown, please don't hesitate to reach out after this session. First, before we start, we also want to make sure you are all aware that we are recording this session so our community can view this at a later date. Our team might also pop in to take some screenshots for social media. And with that, I will let Andrew Takish, Senior Director of Innovation and Portfolio, introduce our panelists.
Great, thank you very much for that intro, Maya. So really excited to have such a great group gathered virtually today for the third installment of our Investor Speaker Series. So I'm really excited today. We have a great group of investors that are active in the energy transition joining us today. So all of these folks have made investments through their broader organizations and Greentown companies over the years. Some of those include Sense, Titan AES, LineVision, and several others. And although, pretty much all of these financial investors, first and foremost, they do engage their LPs and broader partner networks in unique ways that make me personally think these could be very strategic sources of capital for you, our members. So I encourage you, the audience, to ask questions as they come up. We have a great plan put together for the discussion today, but it's always great when good questions bubble to the top and we can pull on an interesting thread when it emerges. So just real quick, would love to quickly introduce the panelists and dive right into it. So first we have Dan Goldman, who's the co-founder and managing director of Clean Energy Ventures. How are you doing this morning, Dan?
Good morning or afternoon now. And if we don't have enough questions, maybe we can get you to play one of your two guitars in the background.
Hopefully we don't get to that point. I probably should have put them in the closet to not even create that option value, but thanks for joining today, Dan. And next we have Grant Allen, who's a general partner at Schneider Electric Ventures. Morning, Grant.
Morning.
Awesome. And then last but certainly not least, we have Shail Khan, managing director at Energy Impact Partners. Morning, Shail.
Good morning.
Awesome. Well, great. I think I want to dive right into it because I think there's lots to discuss. There hasn't been a dull moment. I think Shail in particular, listening to your Energy Gang podcast last night, you reporting out on just having an active mind right now that's busy with lots of activity, not necessarily in the day-to-day of the work, but there's lots to think about right now, lots to impact, especially to unpack as it relates to the energy transition and early stage innovation within it. And I understand how all you folks work is pretty similar to traditional venture capital firms, but there might be some key ways that you would all think you're a little bit different from a conventional firm. So I thought this would be a great opportunity to highlight some of those differences and also, briefly introduce your firms and where you're at with your work. So Shail, would you like to kick us off?
Sure. Pleasure to be here. Thanks everybody for taking the time and excited to chat with Grant and Dan as well. So the quick introduction to Energy Impact Partners, we're about 5 years old, based in New York, though I'm on the West Coast, so I'm in the Bay Area in California. We are investing out of our second fund right now. Between our first and second funds, we have about $1.3 billion under management in total. And the thing that makes us kind of unique is that the bulk of that capital in both of our funds comes from a coalition of strategic investors who are largely utility companies. So not all of the money comes from them, and that's sort of important for us, but the bulk of it comes from these utilities. And it's kind of a wide array of different utilities who are investors in the fund, ranging from like a small local utility like Madison Gas and Electric in Wisconsin, which is my hometown utility, so I'm particularly proud of that one, up to some of the largest utilities in North America. So Southern Company, Duke Energy, First Energy, Xcel Energy, Ameren, a whole bunch of others who are all pretty big. And our model is to treat those utilities much more as partners than just investors in the fund. We ourselves are financial investors. We also have financial capital in the fund. And so we operate just like any other financial investor, and the utilities don't make decisions on our behalf and don't have any decision-making power in investments. However, we work really closely with them. We dedicate a lot of time and attention and effort to building relationships within all these utilities, understanding what animates their behavior, what their priorities are, where they have opportunity to spend. And then we try to go invest in companies that will be strategic to the future of utilities. That's the definition of our scope, which is somewhat intentionally pretty broad, actually. It means all the things you would imagine it means. You know, we invest in a lot of energy technology companies and business models that are directly relevant to the electricity sector. But it also means we can look a little broader than that, because anything that is strategically important to utilities over the long term is important for us to have an eye on. So that's meant we've invested in things in mobility and cybersecurity, industrial automation, and a whole bunch of things that are kind of around the periphery of utilities. And you know, apart from that, we try really hard to deliver on the strategic value that we are promising, both to the utilities who invested largely for strategic reasons. I mean, if we make a ton of money in the fund, they'll be very happy about it, but it won't move the needle on their bottom line. So what they really care about is access to innovation and seeing around the corner and all the reasons that corporates do their own, you know, corporate venture capital efforts. But also delivering on the strategic value to the companies that we invest in. So we have a whole team, for example, that's just responsible for building business relationships between our portfolio, which is 30 companies or so now, and our investors, the utilities. And we track that really closely. We have a German CEO, so we're very metric oriented. So we have over $180 million in bookings so far between our portfolio and the utilities. And we're constantly trying to find new ways to kind of build those bridges between the startups and the incumbents.
It's interesting. And just a quick follow-up question on that. How many investments have you made out of your second fund? Because that was relatively recent, if my recall is correct, or it's hard to get a sense of that.
No, that's correct. We activated the second fund late in the fall, so it's still pretty early. We've made 4 investments out of that fund so far. They've been on the smaller side for us. So I guess the other thing I should say is that we generally tend to like to write larger checks. So ideally, we're writing $10 to $30 million checks at a time. However, we've made many exceptions to that, enough exceptions that like we say it's our sweet spot, but the numbers don't bear that out necessarily. So we've made 4 investments out of this new fund. 3 of the 4 were below that check size.
Well, that's great to hear, with many of our member community being seed to Series A. So that's encouraging. Great. Yeah. And I know you mentioned corporate venture capital efforts and you kind of being a best of both worlds model, how you see it. Maybe that'd be a good segue to kick it over to Grant to share a little bit more about his work at Schneider Electric Ventures.
Sure, thanks for having me today. SE Ventures in a nutshell is a sole LP fund. So most of what Shale went through, I could simply have pushed repeat on that, and it would apply to us. We are a financially incentivized fund backed by 500 million euro. It is a French multinational. It's about 35 billion top line. We have an investment team that is set up as an independent group that can make decisions up to 10 million euros on our own in California. All of us do sit in Silicon Valley. I'm here in Los Altos right now. But the key thing for us is, I think like EIP, we're really considerate about making sure that the strategic value startups come to us to get, we can deliver upon. So we have a phenomenal team of incubation and partnership specialists who have been around Schneider for a long time, know how to unlock that value. In some cases, these folks have run billion-dollar business lines for Schneider Electric. So they really have the secret handshake back in Paris, as I always say. And when we engage with a company, they're looking for strategic value. I don't say that we are strategic VCs in the sense that we are going out with a bifurcated strategic and financial lens, but we'd be silly to say that we aren't going to provide strategic value. So I personally reject the notion that you would want non-strategic capital, because if you're not going to get some strategic benefit, whether it's a brand or some other catalyst function or a revenue lift or something, why would you be taking money from that investor? So that team that we have in place works very closely with us. And if you can look at the headcount, we're a 4-person investment team, growing, but right now it's 4 people. And we have a total group of about 20 that's helping to add value to the companies we engage with. So we've done 15 investments to date. Average check is 3 to 5 million first bite. We're looking to put up to 10 to 15 over the life of the company. And stage-wise, we're looking at more of a barbell, where we're going to do some toehold investments, which are smaller checks up front, but the bigger checks that we do are more Series B and later, where we'd see 5 million plus ARR. So that's kind of how we're going about things. And yes, we're doing some things that might look like they're core to Schneider in the energy management space. We're also looking at emergent areas like robotics, factory automation. We're doing a lot in cybersecurity. We have 2 investments there already. We're certainly biased towards software, and just really looking for phenomenal entrepreneurs that are moving forward fast in the areas that would be relevant for Schneider, but more importantly, where we can come in and really be a force multiplier and engage and make sure that we can impact you in a way that another investor couldn't.
And I guess a follow-up on that force multiplier, I think you mentioned you're a 4-person team. I think this fund was formed kind of in the latter half of last year. Is that correct?
Yeah, it's really gone through 3 phases. Schneider initially did corporate venturing through a separate party called Astor Capital. That was based in San Francisco. We have one of the gentlemen who used to be with Astor now with our team, but that was kind of CVC 1.0 for Schneider Electric. Then they set up this new fund, which was doing some ad hoc investing. They did a lot of funds. So we are now in 6 different venture funds as LPs. And then we fully mobilized the team really over the past 6 to 12 months. You know, I've been with Schneider for about 8 months and relaunched. We had a big kickoff event in San Francisco this past September. And really the team is, you know, more or less fully mobilized now. And what we call innovation at the edge internally, which externally we just simplify and say it's SE Ventures, we have the 3 legs of the stool. So we have the incubation piece, we have the partnerships piece, we have the investments piece. And that team, we're mostly mobilized. We're growing our investments team, but we all work hand in hand depending upon the stage and the style of the company.
Excellent. So that's helpful. So the 20 folks that you mentioned kind of around the core investment team. So those would be those incubation folks that you mentioned. Could you share a little bit more about how you interface to the broder group?
Oh, you already asked for Edison to say hello, so maybe he can explain.
Reveal himself. And we can get into that a little bit more later, just, you know, maybe just briefly to set the context.
Okay, well, in a nutshell, you know, I think fully believe we can't do everything with with just deployed equity capital. There are some times where we want to put in a small check and help, you know, establish a new company that would be very aligned with what Schneider wants, or find a phenomenal team and effectively seed that. So the incubation team is helping deploy those small checks. They're also working with phenomenal groups like Greentown Labs. We have challenges like Big Ideas. We work with other groups like Powerhouse, and we're coming in very early, helping form teams, form ideas, and making sure that those early connections to Schneider are put in place, that there is connective tissue that they can act upon, and that we're kind of graduating companies up to the point where I can put a big chunk of capital into.
Great, that's really helpful. And I definitely want to kick it over to Dan now. Dan, do you want to just introduce yourself, Clean Energy Ventures, and the broader group which that grew out of?
Sure, yeah, thanks. So we are an early stage focused venture capital fund. It's $110 million that we started several years ago. And this grew out of Clean Energy Venture Group, which has been around since 2005, basically an angel group that we created originally with 4 of us. Now there are about 30 partners in that venture group. And the venture group and the fund work very closely together. So we for the life of the group and the fund, we've always focused on early stage, lower capital intensity deals, being very focused on leadership teams and leadership team assessment. And so when we created the fund, we built out a team. We have a 10-person team, including a leadership expert. And then we have about 17 venture partners who are part of Clean Energy Venture Group, who bring, you know, really deep, rich energy industry experience, startup experience, you know, have served on boards for many years. And so we have this bench depth of capabilities that cuts across many areas of the clean energy ecosystem. And that's been really, really beneficial to, both in the sourcing of deals, as we diligence deals, and then most importantly, as we support the companies after we invest. So we typically invest anywhere from 3 to 6 million in a company. We're building a portfolio in a $110 million fund of about 20 to 25 companies. Obviously we have those initial rounds are usually smaller, $1 to $2 million checks, and then we'll reserve additional capital. But we also have limited partners in the funds, some of which are strategics in the oil and gas industry, in the utility industry, consumer products, and a variety of other industries that also can co-invest in deals with us. So our capacity is about 3x the $110 million that we have when we consider our LPs' ability to co-invest with us. We're focused on clean energy, very much looking for intellectual property and sustainable competitive advantage. So probably like a little less focused on software solutions that don't have as much underlying IP. And we're certainly not scared of hardware. We've invested in a variety of hardware technologies over the years. Pika Energy being one that we invested in several years ago and exited last year to Generac, which acquired the company. The other thing I should mention is that we do have a climate impact goal. So this isn't something that our LPs have forced upon us. We don't have really like impact focused LPs per se, but we as a fund have decided that when we invest in a company, we want to be able to demonstrate that company can have a material impact on greenhouse gas emissions. So we like to say some demonstration when the company grows to scale over the next 30 years or so, it can reduce greenhouse gas emissions by about 2.5 gigatons cumulatively over that 30-year period. So we don't think that's an incredibly high bar when you think of the impact of storage or more efficient solar technology or other materials like carbon fiber composites that can lightweight airplanes and the automotive sector. So certainly the 8 portfolio companies we've already invested in have been able to demonstrate that climate impact pretty easily. And the other thing I'll mention is we are very process oriented. When we do diligence on deals, we bring in quite a lot of folks, both from Clean Energy Venture Group, from the fund, and sometimes outsiders. We find that diversity of opinion, that expertise, really helps us think through, what the opportunities are for a particular technology and company, and what the risks are. And oftentimes, that's really beneficial to the entrepreneurs and the leadership teams of those companies, whether we invest in them or not. So we're able to bring the venture partners in for that. And again, even after we make investments in the company, we leverage the venture partners and our group to support those portfolio companies. So it's an ongoing process. And I think what that brings is tremendous depth and understanding of the industry, whether it's thinking about go-to-market strategy or fundraising or IP strategy. So it's a lot of capabilities within our group that we try to leverage. And I think that's a little bit of a different model than a traditional VC, which is typically smaller and might not have the same sort of resources at its disposal.
Got it. And that was a nice reminder on Pika. I think, I'm not sure, but in my backyard in Newton, Mass, which I believe you are also in right now as well, Dan, there is a Generac system that looks suspiciously like an energy storage system in the backyard of my neighbor's house. Do you know, are they deploying with Generac? Are they shipping those right now?
Yes. So this is a really interesting case because, and again, it goes to kind of that deep diligence process. But, when we first invested in Pika, which provides control systems for solar plus storage, allowing, kind of bi-directional flows of power through a very simple, easy to install inverter system. But when Generac started looking at this, they said, well, we have all these generators, backup generators, and we want to get into the solar plus storage market. how can we do that? We need software and we need hardware to do that. And so they acquired a software company and they acquired Pika Energy, and that rounded out their comprehensive solution for that market. They're one of the largest distributors of backup generators in the country. So when you think about their ability to deploy at scale, it was really a great opportunity for them, and you know, a great opportunity for us to kind of create a liquidity event.
And I guess this kind of dovetails actually pretty well into my, first question, which is, I think we've all kind of chatted about the strategic value, once an investment is made, and that you're all thinking strategically about, widely financial investments. But, just curious, Dan, if you can share anything about, your role as an investor in that process, because my understanding of Generac was their backup generator systems were quite antiquated. And was this one of their first serious investments in the clean technology space or acquisitions? And to the extent you were involved in illuminating that would be helpful to know.
Yeah, I mean, it's a very interesting story. I don't want to spend too much time on it, but when Pika started talking to Generac about 2 years ago, Generac said, look, we can't keep them, and we're not interested in solar plus storage. We don't see the future in that. A year later, they came to Pika and said, we want to get into the solar plus storage business. So their strategy completely changed in the course of 12 months. And that happens frequently among strategics. And, I'm sure Grant can demonstrate examples of that within the Schneider organization. But, that's to be expected. And so I think one of the things we try to do, and obviously it's never perfect, but we'll work backwards in our diligence from where is this company going to be in, say, 5 years? And based on the milestones that we would expect it to meet, who might it be attractive to? Who might acquire the company? Because ultimately, we're not really investing in companies that are likely to have the scale or the size of public offerings within that sort of period. So we're really looking at what is the exit? What is the strategic exit for a company? And we'll work backwards from that exit to the milestones they need to make, how many different rounds of financing might they need to get there, and then bring it all the way back to where we are today. And if that's a credible case, that helps us figure out whether we can make that investment. But we really have to see what the strategic value is to an acquirer. And in fact, during our diligence, we'll frequently talk to potential acquirers and understand, what their pain points are, what their needs are, and whether this would fit once it reaches some level of scale.
So that's helpful to understand. Of course, I did want to get into the Pika story a little bit, because I believe, if memory serves, before my time at Greentown nearly 4 years ago, I think Pika was briefly a member of the Greentown community.
That's right.
Although that was a while
but a
ago.
member.
Yeah. We're pretty proud of that one, and really happy to see the involvement. Obviously, you are a part of our partner program. We've been working with you for a number of years. So it's just, I'm still buzzing from that that awesome outcome. And now, maybe this is kind of an interesting question, I think, what came up in our prep call. And I'd love to kick this over to Shale to kick this discussion topic off. But, even if it's clear as a founder that there's strategic value, like, any advice that you have, being on the other side of the table, on how a founder might qualify this value?
Yeah, I think it's an important question, because I think, well, it'll be interesting to see how things change now post-COVID. But sort of pre-COVID, I'm sure many of you know this, but there's been more total dollars in the coffers of venture capitalists than we've ever seen in history. That's still true today. So it's sort of mitigating some of the impacts of COVID on things like valuations and new funding. But there's just been a ton of money flowing around the VC world. So there's been a big effort amongst venture capitalists in general, both the sectorally specific and impact-oriented investors, and even just the general Silicon Valley crowd, to differentiate. And a lot of the ways that they differentiate are on providing strategic value, or at least claiming to provide strategic value. So it's been common that if you were an entrepreneur, you're looking to raise capital, that basically every investor you talk to, the more interested they are in you, the more they're going to tell you that they will deliver strategic value to you. And that strategic value can come in many, many different forms. There's the connections to big corporates type of thing that Grant and I were talking about. There's also the, like, we can help you with your strategy, or some of them have, HR support and all sorts of different things. And I think that's all very important. I agree with Grant. Why would you take money? If you have the option, right? If you have multiple potential sources of capital, why would you select one that isn't going to provide you strategic value? So you absolutely should do it. On the other hand, I think that there's a gulf between saying that you will provide strategic value and then actually doing so. And so I do think that entrepreneurs should, if they have the opportunity, do their own diligence on potential investors, which is just a good practice in the fundraising process anyway. And you should try to vet what exactly is the strategic value that this investor can deliver to me and to my company. What value will that hold for us? And do I think that they'll deliver on it? How to actually go about doing that, there's a bunch of different ways. I think for the most part, it is probably important to note, I think you have more leverage in the negotiation and more ability to ask these kinds of questions as you get further and further into diligence. So you don't necessarily push this up front. The early conversations that you have with an investor are mostly you convincing investor that you're a good investment. The further you get along, the more you can start to open up the questions around, well, why are you a good investor for me? And so ways that you can sort of vet those types of questions, strongly recommend that you ask to speak with other portfolio CEOs. That's always good practice. You want to understand, particularly, for the individual partner or investor who's potentially, especially if they're going to take a board seat or something like that, you want to understand how they work with companies, what kind of value they deliver, how hands-on they're going to be, where they focus, where they're good, where they're bad, et cetera. So just as they're going to ask for lots of customer references from you, you want portfolio references from them. In addition to that, some of the companies so we tell a big story about delivering strategic value. Some of the companies that we've invested in have never really tested us on that in the process of diligence, and some of them have really pushed us on it. And the ones that have really pushed us on it have, they've asked to speak with some of our investors. They've wanted to spend some time, like separate from the diligence conversations, having a strategy conversation with us around how we can actually work with them. And those ones, I think, post-investment have turned out to be the ones that often are getting the most strategic value, because we did have to put that kind of thought into it. They already had some idea of how to structure themselves and who on their team was going to be the right fit to work with us and so on. So I feel strongly that if you're in a position to diligence the strategic value of an investor, you absolutely should. And you should put the onus on them to show you how they're going to deliver that value.
And then maybe just a follow up on that one. So you mentioned after the investment's made that, the ones that are, really active in following the course that you mentioned through the diligence process tend to be the ones that extract the most value. So, maybe related to that, I think 180 million in bookings between your portfolio companies and LPs that you mentioned. How involved are you in making that happen, or is a lot of that driven by the founder themselves and their push to extract that value, or is it a bit of both?
It's a good question. It's a bit of both, and it's situation specific. I would say, at the end of the day, we're not selling for our portfolio companies. Our LPs wouldn't want us to do that, and the portfolio companies wouldn't want us to do that. So we're not putting a contract out. But there's a lot we could do earlier stage in that process. So help the utility sector. It's a complicated sector to try to sell into, notoriously. So understanding, like, how should I approach them? What are the actual things that drive action within utilities? So there's some strategic stuff, and then there's some individual sort of like top of the funnel pipeline building that I think we oftentimes will help with. So portfolio company new to the portfolio says, I have a product that does X. We can look at our 20 utility holding companies, which represent 80 operating companies, and figure out which of those are going to be the best fit and why, and where do we have relationships, and start to build those early connections. And then some help in kind of shepherding a deal through the process because they're also notoriously long sales cycles. So the way that we think about our role is everything from kind of like strategy to marketing to pipeline as it gets through. And then once you're in contracting, you know, that's on you and that's on the utility to get it done.
Got it. That's helpful. And then maybe kicking it over to Grant, because I definitely want to pull on that thread that Dan mentioned on, you know, changing strategic priorities. I mean, you know, last year at Greentown, I was leading our corporate partner program, and I think, you know, Grant, we had lots of visitors and, you know, lots of discussions, and, you know, certainly seen it with other partners. You know, you'll have a long series of visits over years, and, you know, you're not sure anything's going to happen, and then all of a sudden there's a Series A investment when the timing's right. So could you maybe riff off some of what Dan was mentioning, maybe any examples you have within Schneider of a relationship you built and, you know, it wasn't really working at the time, but then something changed internally that made it a priority?
Well, to be honest, I've only been with the company for 8 months, so every relationship's working pretty well so far.
That's good to hear.
Still honeymoon period.
Well, maybe at ABB then previously.
You know, we're all providing value in all these different ways, and you know, everyone's got their own unique shtick. But if you take just the stuff we're doing with Schneider, because that's predominantly, other than having me on your board, you know, why a company would want to work with me. You know, we do have some tips and tricks for engaging that group. It's a big company. We're in 100 countries, 140,000 employees. And as I always say, you can lead a horse to water, but I can't make him drink. So, you know, in a way, we're teeing up things that the business will consume. And that's also why we've consciously decided to go into companies where they're Series B later, they have less invention risk, they have some traction, or something that the line of business can really wrap their head around. I think that's a really important thing. But that's also why we have manpower. I used to be the global head of ventures at ABB, which, you know, is a great company, but we were subcritical in terms of the engagement function. We just didn't have the manpower to steer those projects in a way that would have enough touch points with enough different lines of business to ensure that we had a high hit rate and adoption of the technology that we were pushing through. So I think the first check for startups is really just to see, you know, who the people on the team are. Is it enough heads? Do you like working with them? Do they know the business? Are they insiders or are they outsiders? And we've, again, constructed an investment team that's mostly outsiders, an internal partnerships and an incubation team that's mostly insiders. They know how the company works. So I think that's a critical thing. We're also, because we're not really serving end customers, we're serving Schneider, which is a channel to then get to utilities and C&I customers and all these different end users. You know, we are empowering them to see how can we make their lives better. We're not trying to come in and say what you're selling today is antiquated, you know, it needs X, Y, and Z features. You know, we're showing them how we can be an amplifying force. And I think really approaching it collaboratively with a lot of humility and taking the time with many different touch points along, you know, the course of an investment relationship to ensure they understand why something that we're working with can be not only transformative today for their business, but really lay the foundation for transformation and digitalization over the coming 3 to 6 years, which is really the venture timeframe over which we're trying to work. And so I think that sort of time mismatch is the biggest issue why we don't see adoption. So to your point of why these groups would come in and look at all the great things you have at GTL, but maybe not engage, often it's just a timing mismatch. A business will want something now. They need something to sell. They need to drive revenue. As venture investors, we need to get in to things that we can exit over a venture timeframe, which is going to be, you know, anywhere from 2 to 8 years, and in clean tech even longer sometimes. So we're trying to solve for that impedance mismatch and making sure that there are things that the business can absorb and do things with today, but have enough future ramp potential that when we come in, we can really get up a curve to value, and also plant, as I mentioned earlier, the barbell strategy, enough seeds that are early so that maybe the business doesn't know they need something today. Cybersecurity is a great example. You know, we do internal polling and, you know, people know it's a problem, but security is one of those things where it's not really a problem until you have a problem. And so we're trying to tee up solutions that they will have at their disposal when there is an issue or when it becomes a higher priority once we're out of this COVID mess. So in a way, we're trying to front run them, but not so much that we're going to get ourselves into trouble. But yes, front run them a bit so that we're teeing up things that will be very, very beneficial to this LP behind us, and then they can do really good things with.
Excellent. And I think we have a question actually coming in. I want to do our best to integrate these. So let me just check this one. Okay, so question from Tanya at CEL. How do investors approach that conundrum when for many energy related applications, utilities are the biggest possible market? Maybe Shale would be uniquely qualified to expand a little bit more on this one, and Grant as well. So for well, I think maybe what the question might be getting at is that I think at least what I've seen from some of our members that are trying to sell to utilities, that is hard. I think, and you know, whether they're regulated, deregulated, there might be unique sets of challenges. I'm not so sure it would be a conundrum. It might be a challenging sell. So maybe any advice the group would have, you know, maybe Grant at Schneider as well, you know, on the longer sales cycles, you know, maybe potential mismatches with an aggressive startup timeline.
Yeah, I mean, so that is, you know, I think you have to be clear-eyed about that challenge, depending on what you're comparing it to. There's like almost no way utilities are going to be your fastest possible sales cycle. That said, I would say a couple of things. The first is, this is an ongoing learning for us, but we do have examples in our portfolio where companies that are selling pretty much exclusively to utilities have been able to short circuit sales cycles to some degree and scale fast. So we have one company in our portfolio, for example, that basically exclusively sells to gas utilities currently, and they're selling a risk mitigation solution. So it's basically using analytics to predict where there might be corrosion in gas pipelines or methane leaks or a bunch of other things. It turns out that that risk was really acute for executives at these gas utilities, and so they can kind of move mountains to move faster. So one of the big learnings for us has been there are shorter sales cycles that exist within these sectors. You just have to find the solutions that are acute to the C-suite. As Grant's been talking about, cybersecurity is another example of this. We have a bunch of cybersecurity companies in our portfolio. They are, you know, some of them are basically just selling to utilities and are venture grade companies. So, I mean, the first point is that it's not universal that the sales cycles are as long as you hear about notoriously, but it does and you having a really clear-eyed picture here and what the executives care about. The second point is, you know, utilities for a lot of companies can be a vertical and not the vertical. And this has been a big investment strategy for us, is we can, you know, utilities are tantalizing because they are a big market, they spend a lot of money, they're stable, right? So in an environment like today, where depending on who you're selling to, the companies who could be your customers, the customers, the individuals who could be your customers, are in a recessionary environment, that's particularly challenging. Utilities are going to be more resilient than most, and so they're good customers. So the other, so depending on your product, the other answer to this question can be treat utilities as a vertical, and then figure out how to try to short circuit the sales cycles in that vertical, but don't be entirely reliant on it. So sell through channel, sell through the Schneiders of the world, sell into other verticals that are unrelated to electricity, but build a big business around utilities as well. So both of those things have proven successful for companies within our portfolio, but in either case, you know, I think it does require a fairly significant amount of customer discovery before you go to market at scale with the product, because the things that you think might be attractive in utility world may not be. It's not always super rational, right? It's the world of regulated monopolies. You just got to come to learn it better.
I think the customer discovery is key. I think that's one of the reasons you want to work with groups like EIP that can be a conduit to touch lots of different groups. Again, they're not going to do your sales for you, but they're going to get you some exposure that you probably wouldn't otherwise have. You know, for our companies that are selling either entirely or predominantly to utilities, which I think is generally something that investors will shy away from because it does extend your sales cycle. Just make sure that you're selling aspirins and not vitamins. And what I mean is something that solves an acute pain you have today and not something that you're told to take every day, because if you don't, bad things will happen. Now, there's plenty of businesses that can be built on the latter, but it's not really a great way to convince that C-suite decision maker that they should be buying your product today. So, we like the vertical of many. Security is one of those things. There's a lot of surveillance things we're in, and then frankly, even around feeder level distribution, kind of DER management. We're still trying to take those businesses into other verticals to say get into CNI asset control and make sure you're diversified beyond the core utility set. So I think there's a lot of things you can do to help your business increase robustness, but also prove to investors that this isn't something where you're completely at the whim of these utility sales cycle discussions.
And just a follow-up question on that, I'm curious if you have any examples from your previous experience where maybe a broader global corporate go-to-market channel has been really helpful in quickly identifying one of these acute pain points that Shale was mentioning that be a little bit tough for the company themselves to otherwise do.
Well, for us, I can talk about AutoGrid because that's a joint EIP and Schneider investment. For us, it is highly strategic for Schneider. We own a decent chunk of the company, but when we look at the 5 different engagement points with AutoGrid, one of the most interesting is one where Schneider is internally building a company to go out and provide energy as a service through large microgrid projects, what we call Alpha Structure, which is a JV we've set up with Carlyle Group. And then we have a mid-sized microgrid builder called 5D that we're building. A critical feature that those platforms don't have today is asset control. And that DERMS orchestration software layer is something that we necessarily need to go out and partner to have those features. So that's one of the predominant ways we're engaging with AutoGrid and using their software. So for us, it's early green shoots, and working with the company, we are driving some revenue, but it's clearly something Schneider needs. Software is phenomenal, and we're going to help them as a channel. So it's kind of the stars have aligned, and we're one of the fastest growing, I think, if not the fastest growing channel partner for that company.
Awesome. And then I think I heard some chatter on the line. Did Dan or Shale want to add anything to that?
Well, just very quickly, I mean, we have companies in our portfolio that are selling to utilities. And I would agree with Shale and Grant that, you can't necessarily always assume that should be the only vertical. And so in both cases, there are other verticals that they can sell to, and their value proposition is not just for the utility itself. So in the case of Connector, which is a company that makes a meter collar, not only are they providing grid edge information that's critical for utilities, and that's the value proposition there, but they're actually making solar installation, solar storage, EV charging installation much less expensive. So they have this dual value proposition that's really interesting in order to spur on adoption. The other thing that's interesting with respect to Connector, and I think this is kind of a good model, we actually have a utility investor in the company that we partnered with. And I don't know if we would have gone forward with that investment without having that kind of validation. And so Avista, which is a Pacific Northwest utility, famous for really spinning out some interesting technologies, including Itron, the meter company, co-invested with us in this, in Connector. And that gave us a lot of confidence that, at least for one utility, they saw the value proposition, they saw an expansive market opportunity, and they themselves want to use it for some really interesting use cases. So having a utility at the table, I think, can be really compelling. I'm not suggesting that they have to have kind of any special sauce. They should be an investor like anyone else, but certainly, I think it's validating when they put their money into a company. So that's something we frequently like to see, whether it's a utility or any strategic. We like to co-invest with strategics because it provides us with a little extra validation.
And one thing we always tell our startups too is act like a chameleon. And by that I mean that you can change your color, the way you look, the way you act, to make you either not seen by utility or in more cases seen in a better light by utilities. So some of our companies are reskinning, repackaging, or using channel as a white label conduit so that they can reduce the perceived risk by the end purchaser. So Sense is one of those. They're doing non-invasive load disaggregation in the resi space. We actually have a product. We took the reddish Sense meter. It's now green, basically the exact same thing, and it's now a Schneider product. Completely different conversation in terms of selling it as a Schneider Wiser home product. So that's something where you can reskin, recolor, and it does change the conversation because you're buying from Schneider, not from a startup that's not guaranteed to be around in 5 to 10 years.
I was glad you mentioned.
Andrew, could I just also,
I
forgot
ahead.
one thing, which is just based on the comments. I think it's really important to make utilities pay for their pilot projects as well. So I think one of the comments was they signed a utility contract in January of 2019, no cash flow until this summer. So, I mean, in all of our cases, the companies have sold product or service to the utilities and gotten paid in real time. I think that's important because utilities should have skin in the game when they're doing a pilot or a larger deployment. Sorry.
Oh, no problem. Please go, Grant.
I said it's a good point.
Excellent. Well, I want to try to integrate a couple more of these questions here, and obviously, I think we've kind of avoided talking about it too directly now. But the current public health crisis, obviously there are a lot of challenges, uncertainty. The broader market conditions for the energy space have been interesting, to say the least. I know Shell has been mentioning this and talking about on some of his podcasts that he works on with Green Tech Media. And we've heard a little bit about this, and I'm an infinite optimist, so I can always see a potential silver lining even in a situation that is decidedly not positive for anyone on average. But do you think coming out of this there will be any particular business models, innovations, or approaches that will be particularly powerful or hot coming out of this? And kind of related to that, do you think utilities will look at certain areas, face a major, reinvention imperative, especially with aging infrastructure and urgency around electrifying? Could that accelerate these cycle times we talked about, and maybe it being a little bit tough to get, these contracts, these pilots squared away? Could you see that accelerating in some areas?
I guess there's two questions there, right? There's the COVID, what happens post-COVID question, and then there's the utility reinvention.
Utility impact piece.
Yeah. So maybe, the first one's a big question, so maybe I'll take a stab at that, but then Grant and Dan should jump in because it's kind of the biggest. This is the question for all of us globally at this point. So here's in my mind, the biggest challenge at the moment is the uncertainty. It's greater uncertainty than you typically see in a recession, in that we don't know what track it's going to take. We don't know how long. We're in this immediate phase of shelter in place. We don't know how long it's going to take, what it's going to look like to come out of that. And then we come out of that, and then it looks maybe a little bit, at some point, whenever we do, sometime in the next 18 months, hopefully a lot sooner than that, then it looks a little bit more like a traditional recession potentially, and then you can sort of predict based on that. So the uncertainty is a killer in the startup world, and particularly uncertainty around timing. But I think broadly, where we think there's increased opportunity at the tail end of this are a couple of areas. One is, and this is sort of to the treats, not medicine. I got it wrong. Something not vitamins.
Aspirin, not vitamins.
Aspirin, not vitamins. Yeah, I like that. Okay. I guess that's even stronger, I think, in this context. And particularly
something a little stronger than an aspirin right now.
Yeah, exactly. Morphine, not vitamins. Stuff that
be injected with disinfectant. You're all good.
Yeah, right. Or sunlight.
Hopefully we can all skip that. Yeah.
Yeah. Look, if you're providing a solution that saves money and or reduces cost in some way or another, and that savings manifests immediately, those are two important points. You're better off than selling any kind of a solution in a recessionary environment that costs more, whether upfront or over the lifetime, right? So it makes it all the more important to offer solutions for financing for whatever you're going to be offering if you have customers that need that, and to make sure that you structure your value proposition accordingly. Basically, just assume that discretionary spending, whether it be from consumers or from enterprises, is going to be taking a hit, if not disappearing, for some time. So that's one sort of major area of focus. I think a bigger question mark is, will there be increased opportunity for the types of things that offer some degree of resilience? So call that cybersecurity, call that grid resilience, call that whatever. There's an argument that I think is a legitimate argument that COVID will ultimately expose to us the fragility of a lot of our systems and accelerate the pace of investment in solutions to minimize that fragility. On the other hand, solutions that provide resilience also tend to cost, they're a net increased cost generally. It's hard to find something that makes you more resilient and saves you money apart from avoiding a black swan event that is very expensive. So that one I don't have a great answer to yet, but I think I've seen strong cases on both sides. And then the third big open question in my mind is, what sustained impact will COVID have on individual behavior, and what knock-on effects will that have on opportunities for technology? So obviously the most immediate and salient example of that is, once these lockdown orders end, will we still see more people working from home? Will we see changes in transportation patterns? Will we see changes in public transit and how public transit has to operate? Like, all these things are entirely possible as well. So I'm not really answering your question, because I think it's like the uncertainty is real for everybody, but I would develop a clear picture of how you think whatever your solution is fits into a shelter-in-place world and then fits into a recession.
Yeah, I would agree. This is, I think, as you've highlighted in the past, Shale, one of the known unknowns. This is a big question we're grappling with internally. Now, at a micro scale, we're very simple-minded VCs. We've gone through all these areas that, in a bubble, will be dramatically impacted. Some on the positive, some on the negative. And first we start off with what we absolutely know. There's plenty of dry powder. We are going to stay active. We're going to continue to look for things that are going to be buoyed by COVID and not completely tamped down. So touchless working, cybersecurity, augmented operations, connected workers, e-commerce even. These are things that are clearly going to see a boon over the coming years. There's also a lot of things we know that we just don't know around what the recovery looks like. Latest I heard was it's going to be a Nike swoosh. It's going to be a nice uptick, but the tail is going to be long. Internally, to be very open, we're planning on a bit of a W, and that there's going to be some degree of pickup mid-late summer, when people who are very antsy and kind of sick of working from home and being on quarantine are going to go out. We're going to see an increase in infection rate and a lot of absenteeism over the summer. And this is going to be part of a prolonged recession that I think is going to take some time to get out of. So in terms of the higher order impact on the trends that we're analyzing, in some cases we have some conviction that they're bets to be placed. In other cases, we're still scratching our heads. So EVs is one of those. I think overall, I'd like to be optimistic, but where the price of oil is, I think that fleets are going to scratch their heads and say, are we going to delay transition from ICEs? For people who are looking at upgrading, quote unquote, to an EV, which is still viewed often as a luxury upgrade, they're going to likely delay that, like they might delay upgrading to a home energy storage system. So I do think we're going to see a push out of the adoption of pure electrics. And you're seeing what's happening with the charge points of the world as a very major trend I think will continue. For us, we're very, very bullish on anything that's automation related, looking at our supply chain. We're pretty far along in diligence on a warehouse robotics company. So again, some things we're very short of, but in terms of these bigger order effects, EVs, grid resiliency, energy storage, still a big question mark.
Awesome. And then I do want to make sure I get a chance to ask this question. It is getting upvoted in the chat. This originally came from us from Sam White, who's a founding member and board member of Greentown Labs. So he's curious to hear from all of you, you know, what advice you might have for clean tech startups with hardware, equipment service models. You know, the long-term outlook for these companies might be really good because, you know, the energy transition's here to stay, even though if it's a little bit weird in the short term. So some of these companies might have customer delays, supply chain disruptions, struggling with availability of financing. So, you know, do you consider these type of models less attractive from an equity investment perspective, at least in the near term? And kind of a second part to that question is, you know, have you seen any cool examples of companies adapting to the current situation and market conditions? Maybe
Well, we do have one company in our portfolio that I think is a similar model to, somewhat similar model to Promethean. And Sam and I have talked a lot about Promethean over the years. And the company's Spark Meter, and they have a product service offering for emerging market microgrids and microgrid developers, as well as distribution utilities in emerging markets. And so it's a combination of hardware metering, hardware solution, combined with a software platform to allow the distribution utilities and the microgrid operators to manage their customers effectively. So they're combining this package, generally selling the hardware up front and sometimes selling the software up front for 5-year contracts, and sometimes selling the software over time. But the point is that it is a sort of a service model. And throughout the last several months, what they've found is that, you know, while it's sort of difficult to go into these markets and do deployments, the interest in this product service offering is enhanced by COVID, because this is a solution that avoids people going into the field. It allows you to control everything from an online platform. It works in you know, challenging bandwidth, cellular type environments. And the opportunity is only expanding because the ability to electrify, you know, 1 billion people without electricity and another 1 billion who have very limited access to electricity is a high priority for development banks and the governments of these countries. So, you know, to answer the question, I guess, I think this is kind of a time where you can build the top end of your funnel and really, you know, start to build your customer relationships, think about your product service offering in a post-COVID world, and how you might message that slightly differently. Because, you know, you may not be able to deploy in the field right now. In most cases, you're not. So building that messaging, building your product, enhancing your product, and interfacing with customers to, you know, kind of, you know, build that pipeline. We see that as the strongest things that you can do right now. And then, of course, like everyone, you know, trying to cut your costs back and preserve your cash runway for as long as possible is something we've been working very closely with all 8 of our existing portfolio companies. And like Shail and Grant have said, we're open for business. We have 3 deals in diligence. We just completed a financing of Clear Flame Engines, which was announced earlier this week. And we're very active in things like materials and mobility and energy efficiency within commercial buildings. So definitely not slowing down the pace of investment.
This is definitely something I wanted to chat about, you know, just how you're all thinking about new investments. And just I imagine due diligence must have changed a little bit since pre-COVID. So, how's that working out for all of you? Is it easier or harder in some ways, or are you all moving forward with new investors, investments? Kind of curious to hear from Shale and Grant. Obviously, you have capital to deploy, but the short term's a bit weird.
Yeah, I mean, our budget's still, we're going to put out $170 to $100 million this year. That might be off a little bit, but is it impacting us? Certainly. I had an intro pitch with an entrepreneur yesterday. First time I had ever spoken with the gentleman. Phenomenal business. At the end of the call, though, I said, if you're looking to close in 3 to 4 weeks, for me to convince my partners that I'm going to strike a $5 to $10 million check into someone I haven't sat down face to face with is going to be tough, nor seen a deployment live. So to the latter, I actually go to one of the factories where they are deployed, but it's more of a question of, can I even get into the factory and see the thing in action? So in that case, we'll probably have to punt. Maybe we lose the deal. In other cases, we already know the company, and it's frankly, more of a situation of, is there a deal to be had? So there are a good list of companies that we've tracked. We thought they're a little pricey, and now they're coming back to us and saying, well, we need to top up. We want to have 8 to 12 months of cash. We want to have 24 to 36 months. We're giving most of our companies. And to do that, they're taking top up rounds, often at flat valuations, maybe a slight downtick versus their previous rounds if they raised in the last year and a half. And we're just being that buffer capital. And of course, bringing the strategic element of Schneider, which can help them during this recessionary period. But there are those companies that we're proactively going out to and saying, hey, let's actually have a conversation. With $3 to $5 million in top up capital be helpful. We can still get through that. We are working from home under a Schneider mandate through the end of May, if not much longer. So I ain't going to be getting on a plane anytime soon, which my wife really likes. But it is changing the name of the game for diligence.
Yeah, I think
just go ahead, Joe.
I was going to say, I think Grant hit 3 things that are good sage wisdom for entrepreneurs who are thinking about raising in this environment, which is, I mean, first of all, every VC is going to say we're open for business. Like, nobody is publicly going to say we're stopping investments, right? That's just the reality. And I think actually most are open for business. Like, most investors who still have dry powder are actively looking at new deals, and many are doing them. However, it is also true that I think almost universally, I'm sure there are exceptions to this, but in most cases, timelines are stretched. So to Grant's point, don't expect to kick off a round and have it close fast. Give yourself as much time as you can. Second, pricing has shifted. Like, that's just the reality. Valuations are different than they were pre-COVID. So expect that, and don't undersell yourself, but set your sights accordingly. And third is, and this is the trickiest one, I think, is that I do think it's true for most investors that, it's easier. It's certainly more comfortable and easier to get through investment committee on something where you've previously spoken to the company, spent some time with them, and are now coming back and saying, oh, did they, how have they performed against what they told us a year ago, or whatever it's going to be. That's easier. So if you're in the position of raising, go back for sure to start to the list of everybody you've ever talked to historically, because that's going to be the easiest conversations to have. The harder ones are going to be building the relationship from scratch today. I don't think it's impossible. And, as Grant was just saying, you still haven't called to new entrepreneurs, as are we. But those are the ones that are just going to take longer to get through the process, because everything is gummed up in the works. And meanwhile, there's also a practical reality of investors that have portfolios are spending more time than they would have otherwise been, and more time than they were historically, working with their existing portfolios, which is tough if you're an entrepreneur trying to raise capital from those companies, but it's exactly what you would want if you were one of these portfolio companies. We, and I'm sure Grant and Dan, are spending a lot of time with our portfolio right now. So just, to the extent that you can, with the cash runway that you've got, extending it as far as you can, recognize the practical reality of fundraising in this environment, and don't get disheartened about it, because I do think it's happening, but just realize that it's going to take longer and probably be cheaper.
And I would also just add that in some cases it may be a very painful thing to go through, but the positive silver lining to all of this is that most of the cuts that I have seen being made across my portfolio have a majority of them that I would put in the camp of healthy belt tightening, of getting rid of non-performers and extraneous projects and other things that I think will make the company leaner, fitter for scale. And then when we come out the other side of this, positioned really nicely in terms of rationalizing what the company is doing and solving the very most acute pain points. So really rationalizing what that product market fit looks like. So I'm positive about that. You know, it's not been easy. We have some of our companies that have done RIFs, you know, cutting down as much as 40%. You know, others are less impacted, but it hasn't been easy for the bulk of our companies. And you know, we expect a few more to kind of have some issues over the coming months. But again, positive processes.
And then I think another thing I do want to make sure I mention that I think's been touched upon, you know, across all of you on the discussion today is, and it's actually been brought up by other panelists in our previous iterations of this event, like Matthew Norton and others, is just the need to do scenario planning. You know, you have your 3-year plan, your 2-year plan, your 1-year plan, and even 6 months, and you might never get to the 3-year plan, but, you know, Cheryl, this has me thinking about what I think you were mentioning on some media as consuming that you're a part of, that, you know, perhaps one silver lining here and related to Grant's point is that this, you know, strategic planning is going to be embedded into the startups, you know, planning operations more than it ever has been previously. So, you know, I'm curious, do you already see this happening in some of the new discussions you're having with companies now?
I mean, yeah, I guess I can add a little more color to it. So one thing that I've noticed, I'm curious whether this is true for you guys, Grant and Dan, as well. So a lot of our portfolio, so when we make an investment in our internal diligence process, we run, just as a rule, we always run 3 scenarios for every company when we're doing our financial modeling. We run a bull case, which is basically the management case, what they're telling us is going to happen. We run a base case, which is our sort of independent view, and then we run a bear case, what happens if things don't go according to plan. We would do that internally on the investor side. Our companies generally, you know, are operating off of fundamentally one plan. They set a budget every year, that budget gets approved by the board, then they operate against it, and they would go back and, you know, make changes and adjust throughout the year, of course, but they weren't doing like really, for the most part, I mean, there are exceptions to this, but for the most part, they weren't doing really robust scenario planning. And in particular, what they weren't doing before was saying, okay, here's a few different scenarios, and then depending on what we're tracking toward or trigger points, here's what we would have to do. Here are the impacts that here's what it would mean for our business. Here's where we would prioritize or not prioritize, or in the case of the bear scenario, here's what a RIF might look like. They weren't always doing that as a general rule, but they absolutely are all doing that now. Like every portfolio company is saying, okay, well, we have so much uncertainty, we have to design out a few different futures, and we have to know now what our actions are going to be in those different futures. And it also makes the really hard decisions, I think, a little bit easier if you had trigger set out ahead of time, makes the decision a little bit easier later. So I'm hopeful that one of the silver linings here is going to be this kind of scenario planning, which was not baked in for most of our companies before, perhaps will be in the future, because I'm finding it to be really, really valuable in seeing how they think about what happens in different scenarios and what it'll mean for their business.
Yeah, and like I said, there's these things that they're very tough to do, not pleasant conversations to have, but very healthy processes to go through. And I include our own group in that, where we can often get by with okay, we're seeing some growth, but you're not really scrutinizing, say, the burn of the company. So with our own investment team, we've had some of the tougher, but I think healthiest conversations we've had since I joined around what exactly we believe with this set of 15 companies we've already supported and the companies to come. What do we have to believe to really get conviction that these are going to move the needle for not just us, but for the LP that's graced us with this 500 million euro pool of capital. So again, tough conversations, but I think they're very healthy. And whether it's a very protracted W-shaped recovery with a lot of pain felt for the next 18, 24 months, we have to be prepared for that. And that's not just a portfolio, but for us as an investment group. So we've gone through that, and have looked at how we will react, and I think we're well prepared.
I'll just quickly add to that. I mean, I think one of the things we're big believers in is using an OKR process, objectives and key results, to help prioritize your activities. And that could be, like Shao was saying, a really good exercise for figuring out what you really, really need to focus on in the near term, and what things you can put on the back burner and not spend money on and not spend human resources on. So we do that ourselves as a fund, and our portfolio companies have been aggressive in adopting that OKR process. And I think one of the things we've seen during this crisis is really the maturity of our leadership teams has been demonstrated and is absolutely unbelievably impressive. And I think it goes to our focus on that before we make investments. And really, we might have a mediocre technology, but if you have a really excellent leadership team, you can have a successful outcome. I don't think the reverse is true. And so we really have always been especially careful about making sure we're backing great entrepreneurs. And it's really come through during the pandemic, because we see how professional they've acted, how they've acted really quickly, and taken decisive but very hard action to do what's necessary to preserve the business. And it's not easy. They have personal relationships with their staff, and it's just extremely challenging, and we recognize that. But it has been impressive to watch the action they've had to take. And we've been aiding that in the PPP applications by creating a user group with all of our legacy as well as new company CEOs on the list, and being able to share information across that platform has been really effective in terms of in a fast changing PPP application process is one example, sharing the best practices and what can go wrong in that process. And so we hope to leverage that in the future for best practices around other areas.
Great. Maybe to keep with you, Dan, here for a second. I think we've all talked about, so the work's going to continue here. You've all, you have active funds now that have capital to deploy, and you're working with your existing portfolio companies really closely, maybe more closely than at any time previously due to the circumstances. So, kind of curious to know, maybe Dan, what are you doing with your portfolio company to, what resources are you connecting them to, providing, additional support beyond just writing a check? So I know, another hat you wear is, if being the managing director of your fund wasn't enough, you're also the vice chair of the Northeast Clean Energy Council. I also know Shale is on the investment committee of NYSERDA, which is like the analog of Mass CEC in New York, but 10 times the size. So, how do these other hats you wear, factor in or, create synergies with the work you do with your fund, if at all, or do you keep those separate?
No, we view the ecosystem as completely integrated, and we all want to try to be good participants in that ecosystem and build the ecosystem. We've been doing it since 2001, 2002. So this has been going on a long time, and it's not something we ever plan to reduce our commitment to. So talking to like the Mass Clean Energy Center, to NYSERDA, which I talked to earlier this week, about programs they're thinking about to address both the pandemic as well as the commercialization of new technologies in New York, where they've just passed groundbreaking legislation to decarbonize by I think 80% or 85% by 2050. And so we want to help the regulatory infrastructure to create an environment where these technologies can get adopted as quickly as possible. That's good for decarbonizing the economy. It's good for the companies. It's good for creating jobs. It is the growth engine, I believe, for the next 100 years, or one of the biggest growth engines at least. So one of the activities we undertake just naturally is to engage with the ecosystem, and that includes Greentown and other incubators around the country to do whatever we can to help them cultivate companies that ultimately we can invest in. As you mentioned, the Northeast Clean Energy Council and their advocacy, their Innovate program in the 6 New England states and New York, so 7 states. And then for entities like NYSERDA, Mass CEC, and even ones in California as well. So that's, I think, it's all integrated. What helps the ecosystem, helps our companies, and also addresses climate change.
Thanks, Dan. Anything to add, Grant or Shale there?
No, I agree 100%.
All right, good. I think we summed it up, but I mean, Dan did touch on something there with the NECEC, the advocacy role, and I think, this question has come up in the chat, and obviously, I'd imagine you're making a lot of investments that aren't dependent on policy to be a financially appealing investment. But to what extent, do the different hats you wear, even directly at your funds, do you participate in advocacy, or how do you, view policy's role in accelerating some of these trends? Like, what's really needed here?
I guess on our side as a firm, we do not advocate. We just don't view it as our role from a policy perspective. And particularly, most salient to us, because we work with a bunch of utilities, there's a regulatory context in addition to a policy context that we stay as far away from as we possibly can. So we don't directly. Similarly, we try not to make investments that are totally dependent on whether on new policy or new regulation in order to be successful. It's just a risk that's tough to take as an investor. That said, we obviously have companies in our portfolio that could, one, benefit from policy, and two, that are reliant to some degree on policy that's already in the books. So, for example, we're investors in Arcadia Power, which has a pretty big business in community solar. And community solar is, for the most part, a legislated market. It either exists when utilities run community solar programs that they get approved by regulators, or when states pass community solar legislation. So it's not to say that we won't invest around policy, but we ourselves don't tend to participate in the policy process as an organization. We obviously have our own individual activities and personal views, but it's just not the role that we play in the ecosystem.
I can say for Schneider, yes, we do have a Gov Affairs group. It probably comes as no surprise. I can't comment, nor should I comment on kind of the overall operations of that group. But I think for us, it is interesting to see how much change is afoot in terms of all the different stimulus packages that are flying out there. Many of our companies have benefited from the payroll protection program. We've seen even this week, 2 of our companies had dollars arrive in their bank accounts. So I think there is legislation that's happening. And for us as a group, we are working closely now with that Gov Affairs group to ensure that for a CARES Act and other things like that, that there is an increased focus not only on the infrastructure building, which does pull through a lot of Schneider's expertise and specific equipment, but when we look at, say, hospitals, that they have the ability to direct funding to upgrade of their infrastructure to drive resilience. And that is something that will help Schneider Electric. It will help the companies we work with. I think that's where we start to get involved. So I think, never let a good crisis go to waste, as they say back in DC. So I think, there is more awareness, not just within the GR group, but within the broader investment community of how we can come in and not take advantage, but just to make sure we're aware of all these changes and where we could have pockets of opportunity present themselves. and just to make sure that when they do present themselves, that we're coming in with an educated mind about how we can take advantage.
Thanks, Grant. And I'm recognizing, just being kind of cognizant of time here. We have about 8 minutes left, and I usually like to take these opportunities to just kind of learn a little bit more about any parting advice you might have for our member community. But before getting into that, real quick, I want to make sure I go back to some things that were mentioned. I know there are a couple of shared investments between Schneider Electric and EIP. I think Sense was also mentioned, which is another one of those with your recent Series B investment at Schneider Electric and them. But in term, who are your co-conspirators here? Like, or Shale, you mentioned every VC firm's obviously going to tell you that they're still open for business. Some might tell you they're hitting pause for the next 6 months. But are there any like worth a mention here that are really committed in the energy transition to moving forward that you want to give a shout out?
Good question. I mean, there are lots. Fortunately, I think there's been, so even over the past few years, there's been a resurgence in interest in the space. Prior to, so like last 12 months, there was this little boomlet in the idea of climate tech, right? And it was driven in part by some of the big storied Silicon venture capital funds saying, we're into climate tech and we're doing our first deals. So you saw blog posts from Union Square Ventures. They made 2 investments. Sequoia's made at least 3 that are public, and then a couple more I think aren't public yet. So there's some activity there. But meanwhile, even before that, there's been chugging along this, actually what I think of as a pretty rich ecosystem of a combination of financial investors, corporate investors, sort of hybrids that sit in between the two. And it's a good group, I think. And increasingly, I mean, the other area, the gap that has been filled more recently is the really early stage stuff, like seed stage type investing, because there are a whole bunch of funds in that world that are relatively young. And that was where there was I think the biggest gap historically. So we see that filled now. I mean, nobody in particular that I think deserves more mention than the rest, but I think it is actually a strong ecosystem. And even if this sudden excitement around climate tech dies down a little bit, which I suspect it might, that ecosystem will remain. So I think the funding environment is strong generally.
Would anyone agree or disagree there?
Yeah, I'd agree with Shell. I mean, we're lucky now, and if you look at the clean tech 1.0 or 2.0, like 2006 to 2011, I mean, you had some investors, they were more generalist VCs, so their level of commitment to the space was, I think, more questionable. And it proved to be true because they pulled back as soon as sort of things didn't go well, and especially with the financial crisis. But we have a very different ecosystem today with some philanthropic capital at the really early stage. We have kind of end-to-end investors like Breakthrough with large pools of capital. We have things like Prime Coalition and the Engine and Powerhouse Fund that are doing more early stage incubation. As Shell mentioned, there are folks like us who are early stage, and then there's a lot of growth capital out there for taking companies and helping them to scale. And that's, I see Schneider and certainly EIP as really helpful to have them in. And we have a mix of strategics and financials. So one of the things we're working on is kind of a comprehensive co-investor database, because we're constantly trying to pick companies and investors out of our minds, but as we get older, it's getting more difficult. So we're trying to institutionalize that knowledge in a database that we can really look at one of our portfolio companies and say, okay, you're raising this amount of money, it's this stage round, it's this geography, it's this technology, it's a subsector. Who would be appropriate to co-invest in that? And to be able to have kind of something like a smarter, sort of intelligent database that we can go to really gather that information is something we think will be quite beneficial and more time efficient than the way we're doing it now, which is just to pick names out of our heads. So and there are over 1,000 names in that database. So the ecosystem is pretty large.
And we'll see how much staying power there is with some of these groups that have come up and said, we do energy now. I saw the same thing when I was in robotics, and I did 9 investments in robotics and applied AI when I was leading ABB. And there was this wave of all these VCs who wanted to come through and do like, we got to have our one AI robotics company or a drone company. And everyone did like 1 or 2. Most of those drone companies are now kaput. Some of the robotics companies have done okay, but they've taken a lot longer than people thought. Some of the exits like Swift River were encouraging, but there really weren't that many blockbuster returns from a lot of those outside of the medical robotics space. We had one company, CMR, there, but for this one, I think there's a lot of dabbling. I didn't know Sequoia was in that many. I knew they were 1 or 2 here or there, but I didn't know they were that active. And then of course USV was fairly open about coming into Leap. So for us, we're kind of cautiously optimistic that we'll see a resurgence. And I think people are kind of testing the waters. I think the resiliency of the space and the long-term spend that we see as climate tech takes post-COVID, hopefully a bigger place in the common psyche will hopefully be encouraging to the broader set of venture investors. But for now, we're sticking to our knitting. And I think the list of investors that we trust, 2 of whom are on this call right now with us, will stay pretty small for the foreseeable future.
Great. Thank you for all your perspectives there. And kind of in our last minute here, this one might be a little tough to squeeze in, but just real briefly, maybe in a sentence or 2, do you have any final parting advice for our founders that are listening in the audience today, who are fundraising or likely to be fundraising in 2020?
Maybe I could go first because I do need to drop off right at 1:30 here. So I would just say, I think perseverance is one of the most important traits as an entrepreneur. I've started businesses myself, and I think it's critically important. Don't give up, and just, really, this is a time when you can really hone your business plan. Maybe wait a few months to start raising capital, but always good to start to develop those relationships and interactions with potential investors, even when you're not raising capital. So with that, I'm going to sign off. Thank you,
Thank you
for having me, and good luck.
Great, thanks, Dan. Anything else to add, Grant and Shale, as we wrap up here? I know you probably have your meeting to go to right now.
Yeah, my quick 2 cents is don't despair. There is light at the end of the tunnel. We don't know quite how long that tunnel is going to be, but I do see light. And just like I'm doing in my own life, I mean, my daily existence has shifted dramatically, but I'm trying to find these new things where I can drive value and get a lot of joy out of, like seeing my kids a lot more. So I encourage the startups to take advantage of this time. And if you're trying to, say, sell into utilities, work on those other verticals you could sell into. If you're trying to, deploy a business model where it requires on-site commissioning, take this time not just to build up a backlog of sales opportunities, but really work on virtual commissioning and making that process of onboarding and piloting much shorter, and rely upon people who don't need to be on the plane or on-site to deploy. So I think you can be smart, and again, not just try to track linearly and say, oh my gosh, there's now a wall in front of me, but really look for creative ways around that wall. And I think that will really benefit you in the long run when we come out of this.
Great, thanks, Grant. Cheryl, you want to close us?
Yeah, not a lot to add besides, okay, I'll take 30 seconds. There's a game that one of my colleagues likes to play. Imagine you were raising a new child right now, and you could control their strengths and various characteristics. And you have 3 characteristics: intelligence, IQ, emotional intelligence, EQ, and grit. And each of them starts in the 50th percentile of each of the 3, and you can dial any of the dials up and down, but the total still has to be 150. So where do you want your child to be stronger, EQ, IQ, or grit, basically? And I always said grit, and I think this is absolutely the test of that, right? For entrepreneurs, for everybody in their daily lives. So dig deep and find that grit, And as both Grant and Dan said, you know, there's light at the end of the tunnel, but it's going to be a rough road for a little bit. And so we just got to plow through.
Well, and I think that's a great way to
Well said.
close it out. And I think, you know, happy to be in this tunnel with all of you and the broader ecosystem, and glad we could all get together and be close despite the physical distance today and have this great conversation. So one big, huge thank you to our panelists for joining today. We'll be following up with more information with all the attendees for this talk today. And for those of you who are Greentown member companies, startups in our community, please keep your eyes peeled for office hours with our great panelists. I know we have Dan and Grant coming up next week, and EIP will be soon to follow. So thank you for your time and happy Friday.
Cheers. Thanks, Andrew.
Take care.
Bye now.